Okay, so as a trader, whether you're trading longer term or shorter term, medium term, you want to have a directional bias. And through multi-time frame analysis, if you start all the way out, let's say at the monthly chart, you can start to build a thesis based on the trend. So if you take a look at that chart, what is the trend? Well, you can get a line and look at the recent highs. Let's just take these highs, connect the dots. Okay, connecting those dots. So the peaks. And I like to try and just connect everything that's within range. So something like that. So we could say that this trend here, which is sloping down, started to decelerate when the market started moving sideways. So this was the low over here. So down, up. So this is what it's came down. It's come down. It's come down. But it didn't make a fresh. Well, it kind of did. So let's count that as a. Did it? Let's have a look. Yeah, yes it did. So it made a fresh low, but it's not a very convincing low. So we could say that the market's bottomed out and it's come back up. Hasn't made a fresh high yet. It's made a fresh low now. It's come back up. So what we've got here is a market that was in a downtrend and it's starting to peter out. We're sort of in this environment where it's decelerating and it could well come back inside and start to consolidate. Or you might be thinking, well, no, I don't agree with that analysis. What I think is this market is still in a bear trend. Um, you draw your trend line like that, however you want to do it. There are, there are going to be opposing views in the market. That's what makes a market. So let's say, okay, well, no, this is still a bear trend. And you can pull that in like that to justify that. You might say, well, this was a false breakout, very heavily sold off, so I'd agree with that. So maybe best drawing the trend line from down in here. And you're connecting the dots. And we've broken those old lows. We've broken those old lows as well. Um, okay. So the thesis therefore is bearish still while below this trend line. So this has come down, it's broken structures. Maybe it's coming up to retest the trend line to come back down. Okay, so that could be the thesis. So if that is your thesis that you are bearish, then if you're, let's say you're a swing trader and you might be taking your decisions on the daily chart, your directional bias for the meanwhile, even though it's longer term bearish, is for a move up potentially. So what you'd be looking for on the daily chart are signs that the market is getting ready to move up. At the moment, it's coming down, but your directional bias on the monthly chart is up to come down. So you're looking for the market to give you signs that it's about to turn higher. So at this point, you might say, well, I think we're coming into a support area, and I'm going to be looking for the market to decelerate on the daily chart and start to move higher at some point in line with your monthly thesis. So, as a day trader or a swing trader, rather, at this point on the daily chart, you would be looking for the price to stabilize and start to move back up. Now then, let's say um, we're a day trader and we're seeing on the daily chart this sell-off. So the bias at the moment, the directional bias is bearish on the daily chart. We're below this bearish trend, so this can keep selling off. And where is our target? Well, we might say our target is, why not these lows? So there's no rule, depending on your strategy, and but, we can target those lows. So based on our daily time frame analysis, our higher time frame analysis, as a day trader, you might be trading on the 1 hour or the 15, right? But on the 1 hour, the thesis is that this is coming lower, and we can see that this might be resistance here, this candle, green candle. So I'm a seller while below that area. So you might pull up you might get short of the market now. You stop above wherever you, and you're targeting. And this trade, if you sold it now, was based on your higher time frame analysis, based on the daily trend. And then to come down further, you might say, well, if you're a day trader, you might say, right, okay, well, I don't want to be selling at the lows of the day. Based on my 1 hour chart analysis, I've seen that this could be resistance. I've seen um, that there could be an opportunity to sell higher up. So you'd go down to a lower time frame. You'd be looking for the market to be decelerating, which it's doing. You'd be looking for it to come up, monitoring it to come up into where you think the resistance area is, and you might put your sell limit up here, stop above recent swing highs on the 5-minute chart, and that way you're getting a better risk to reward ratio because you're selling higher up and you're waiting for that market to decelerate, trigger you in, and then your thesis is based on the daily and hourly chart that this is going to keep coming down. So it's coming up, it's coming down. Okay, so that's something for you on multi-time frame analysis and how you can factor it into your approach to the market. And then to do a deeper dive, you can do some discovery for yourself. If you look up the fractal nature of the Forex market, that could be quite a good read. I haven't read it myself, but it seems to be in line with what I'm trying to talk about. Yeah, it seems pretty. So if you have a read of that, it'll give you some insight. But essentially, you'll see the same patterns and price action over and over and over again on a fractal basis. So whether it be on the monthly chart, the weekly chart, the daily chart, the 4 hour chart, the 1 hour chart, the 15-minute chart, the 5-minute chart, you tend to see the same patterns turn up over and over again.